Okay, well, let's get going. And then as we have more trickle in, we'll go ahead and add them to the room. Welcome, everybody. I'm Ben Mendenhall, the administrator for the Centennial State Liquid Investment Pool, and I serve as the administrator appointed by the board and been working with local governments here in the state of Colorado for going on 20 years, well, which is hard to believe. I don't feel like I've been doing it that long. But today we're going to be discussing navigating the second half of 2025. And with us, we have our portfolio strategist for CSLIP from State Street Global Advisors, Will Goldthwait, who has over 30 years fixed income experience and is a resident expert on all things related to CSLIP and the fixed income markets. And his team serves as the investment advisor for CSLIP, and he is a resource to everybody on the call. And we appreciate you joining us today. So with that, Will, do you want to kick us off?
Sure, Ben. Thank you for the introduction. Great to be here. So yeah, unfortunately, I have to read a little disclaimer beforehand. My compliance people insist. So before we get started, I must let you know the information in this webinar is intended for the confidential use of clients and prospects of Centennial Advisors, CSLIP, as I know it. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by Ben and I are our opinions, and they are of our respected firms, State Street and CSLIP, and the comments do not constitute investment advice or analytical research and should not be relied upon as such. We're currently recording this on July 21st, 2025 at 1 p.m. Mountain Time. Okay, so got that out of the way. Great to be here. So interest rates, where are we? What's our forecast? What are things going to look like for the next 3 months, 6 months, 12 months? Okay, so we have just revised up our growth forecast for 2026. Simona Modica, who is our chief economist, she had put GDP growth in 2026 at 2% prior to her second half of the year forecast. She just released it. She has revised it up 0.3%. And so we are now at 2.3 projected growth forecast for 2026. She's made no changes to 2020. That still sits at 1.5. And the reason it's at 1.5 is just because she thinks the economy will definitely need some time to adjust to the new big, beautiful bill, as well as all of the tariffs that are coming down the pike. And so there's going to be a lot of economic disruption. We know that. We hear it. You know, some of you on the call are experiencing this every day. And so we do expect that this year's growth will slow. But next year, as we put hopefully all this tariff noise behind us, we should resume growth and hopefully grow at 2.3% according to her forecast. So she is definitely on the upper side of forecasts when I look at economists and look at the projected GDP growth estimates for 2026. I'm seeing them at 1.6 on average. So folks have so she's incredibly more optimistic on GDP growth, and she just feels as though what has been passed as far as the budget is definitely a spending budget. The Tax um, Act of 2017 that were set to expire this year have been extended for the most part. There's some minor changes at the margin, but overall have been extended. Um, and there really hasn't been any significant fiscal spending cuts. Oh yeah, just one other thing. I just want to remind the audience that if you do have questions, please submit them in the chat, or obviously you can unmute yourself or raise your hand, or however you want to get our attention. We'd love your questions. Um, so We are definitely looking more optimistic for those reasons. Just because those tax cuts that came in 2017 have been extended, and that we do not see the fiscal discipline that perhaps Doge was looking to implement really get affected. No real significant spending in government, so that continues to be stimulative. Okay, so then the next question, Ben, that I get asked a lot is, well, what about the inflation side? Aren't tariffs going to be inflationary? And you would think that tariffs would could be inflationary, except for the fact that they are a one-time price adjustment. So when we think about inflationary or deflationary forces for that matter, we're thinking about the continuous increases in prices above and beyond that 2% target. So for example, what we saw in 2021, when price changes were going up by 5, 10, 15, 20%, that is inflationary when we are really struggling to control the pace at which prices are changing. And that's, the Fed's mandate is price stability. So if you take a product, a good, a service, and you apply a tariff to it, really a good in this case, and you apply a tariff to it, it's going to be a one-time price change. Something that costs a dollar is now going to cost $1.05 or $1.10 or $1.25. But it doesn't mean that at the next point of measure, it's going to be $1.50 or $2. And that would be inflationary. So the one-time price adjustment is simply a price adjustment. It's not necessarily inflationary. So therefore, we do think that the Fed is on track to reach that 2% target. They're being very patient and measured to get there, and reluctant. We think that the Fed should be cutting rates in July next week. They're obviously not going to do that. The market is pricing in essentially zero chance of a rate cut next week. But we think they should be cutting rates 3 times this year. And the reason we think that is because we don't want the Fed to wait for the labor market to start to show weakness. And our view is that's kind of the last shoe to drop here. If prices are under control, if monetary policy is still restrictive, 4.25, 4.5 is which is where it is right now. We think neutral rate is somewhere around 3%. So if monetary policy is restrictive, then you would think the Fed could start to ease policy rate further than what they did last year, cutting rates by 100 basis points last year. We think they should start doing that now rather than wait until they still see real weakness in the job market. So that's kind of where I'm thinking we are. We think the Fed should begin cutting now. We think don't wait. And I think the thing that is keeping the Fed up at night, Ben, this is a question that we got posed before the webinar, which is always a great question. What keeps you up at night? What keeps the Fed up at night? But what keeps the Fed up right now? That word transitory. They are haunted by that word transitory, and that's why we are seeing the delay. We all remember that in 2021, even in 2020, as we started to emerge from lockdown, the Fed used the word transitory inflation, one time shock. And so that's why they're keeping Fed funds higher because they just don't want to see that resurgent inflation. Okay, so I'm going to pause there, but Ben, let me flip it back to you. You have been busy. I don't even want to know the mileage on your odometer since the beginning of the year. Talk to us. What's going on?
So, well, thanks for that. Well, yeah, it has been a very busy year so far. I think the odometer, I've lost track at this point, but I'd probably guess in the 10,000 mile range since January. But it's been time well spent out in Colorado, all four corners of Colorado, and really what we're seeing out there, and what we're hearing out there from the local governments that we work with, and the board that we serve is that housing continues to be a major problem out there. And really, the disparity of income here in Colorado to support the average home price, which is now above 600,000, which is very hard to believe. But wages haven't gone up here in Colorado to really mirror what the cost of living is. And right now we're floating around 85 to 90,000 per household average income in Colorado. And to support the 600,000 plus cost of housing, where it doesn't erode more than 50% of your income, is about 115 to 120. So there's still about a $30,000 per year disparity. And when you get more into rural Colorado and the resort communities, we're seeing a large influx of big money that is pushing small and medium sized money. And then people like me all the way down river or into areas of the state that aren't historically a big population center. And we've started to see a tick up in metropolitan districts forming not only on the Eastern Plains, but also in the Southern Front Range. One of the counties in the Southern Front Range, being Pueblo County, is still one of the fastest growing counties in the state, where historically that part of the state didn't really see a lot of influx in. And working with the state demographer and the University of Colorado, we're noticing that there's right around 4,000 to 4,500 people a month moving here, which is back to that pre-pandemic levels that we saw in 2019 of 5,000 people a month moving here. And a lot of the resort communities or surrounding areas are starting to work on employee housing and how they can keep employees close. Aspen is a perfect example where it's Aspen, very expensive to live, but a lot of the people based off of the salaries there are living way downriver in areas like Newcastle and Silt, and even further west, commuting up to Aspen. So how do these communities and these school districts and these special districts attract top talent without having a place for them to live? So, this has been a problem that's been ongoing in Colorado for quite a few years now. And unfortunately, there isn't a lot of reprieve there anytime soon, as long as we have the beautiful nature that we have, which I don't think that's going anywhere anytime soon. We do see the migration to continue in there. But really, there's a lot of more rabbit holes that I could go down with in the Colorado economy, but the tailwinds are strong. We are starting to see a pickup in professional services, a pickup in oil and gas and tech, in defense, and a lot of our diversified economy here in Colorado, which is great. And the increase in tax base with people moving here, it necessarily isn't a bad thing, because that's going to translate to property tax for counties. That's going to constitute an increase in sales tax revenues for municipalities. Tourism is still very strong here. So I think that Colorado, compared to many parts of the United States, is doing much better. I would say we're probably still in the top 10% of economic growth. And I saw a study recently where this is one of the top states to start a business in. So I think that the health of the state is still continuing, and that's some of the trends that we're noticing out there in meeting with our participants and working with local governments, is that Colorado is still faring pretty strong.
Ben, I get asked the question a lot about mortgage rates, and particularly as it impacts people, but also, businesses that are trying to move to communities, and what's the financing rate. And unfortunately, the answer is we're not going back to a 1% or a 0% rate environment anytime soon. And that's a real challenge. So for those communities or those people, I should say, that were counting on that refi or counting on lower interest rates to make it work. It's I don't see it coming, my opinion. In fact, we've seen some challenges with the back end of the yield curve, the treasury curve, because of the indebtedness that this country is going through. So the debt ceiling was set at 36.1 trillion. The big beautiful bill raised that. It suspended the ceiling. And so we're going to see an extraordinary amount of treasury bill issuance over the coming weeks and months, so that Scott Bessent can continue to fund the government. And that's going to be challenging. So 30-year conventional mortgage rates somewhere between 6 and 7%, I think, is where we're going to be for the near term. And I know that's challenging. I guess all I can say is misery loves company. This is a nationwide and unfortunately really a global issue. There is a global housing shortage in developed markets. Because frankly, these places are running out of room.
Mm.
And so it's very hard to continue to build. And, I was talking with a client earlier that has an hour and a half commute in the New York suburbs. And that's kind of a standard commute, hour and a half behind the wheel or on a train. So this
Wow.
is this is a this is a real challenge for everywhere across the United States.
Well, and I appreciate you sharing that perspective because it's become a much different landscape, especially for the kids getting out of college. We've talked about them on previous, webinars and how are they going to survive? And, I guess that might dovetail into my next question for you, which let's talk about cash. It appears
Mhm.
that cash is king again. And I just wanted to get your thoughts on the ballooning daily liquid fund markets and where you're seeing flows and what's going on.
Yeah, certainly it's been remarkable. LGIP balances at all-time highs, registered SEC registered money market funds at all-time highs, private trust funds like STIF vehicles, short-term investment fund vehicles held by the trust banks at all-time highs. We're seeing an enormous amount of cash in liquidity products. On top of that, we have folks like Berkshire Hathaway. Warren Buffett's been very public about his holding of treasuries being at all-time highs and waiting for opportunities. So there's two really stories here. The first is the asset allocation story. And that is those that hold cash for asset allocation reasons are holding cash because they can't find a lot of value out there. Maybe it's equities. Just looking at the Nasdaq's up almost 9% this year. S&P up 7.5% this year to date. So we've seen tremendous richening of risk assets. Corporate credit spreads, something that we use as a proxy for credit lending, at 80 basis points, the Bloomberg IG Corporate Credit Index. High yield at 280, I think. Yeah, 283. Um, that's well bid. It's absolutely an issuer's market. It's a market where we've seen a tremendous amount of issuance, and no shortage of appetite to absorb that issuance. So that's the asset allocation side, waiting for value, waiting for an opportunity to reallocate. So that's why we see cash high there. And then on the local government side, on the corporate balance sheet side, on the institutional cash side, we see waiting for clarity, waiting for direction, waiting on how they're going to deploy funds, particularly on the corporate side. The confidence on the corporate side has been really rattled this year. In the first half of this year, with a lot of uncertainty that's come in, and you can hear this on earnings calls where CEOs and CFOs are talking more and more about that. I talk to corporate treasurers all the time, and they will reflect to me that they did have plans for CapEx, for R&D, for spending that has been put on hold until they wait for clarity. So the hope is in the second half of the year, in order to keep the growth engine going, that they will start to deploy that. But right now, we're seeing it grow more and more. I keep a very close eye on ICI data, Investment Company Institute data that tracks SEC registered money market funds, and it's over 7 trillion right now. So that's been really incredible. Um, so now that we're halfway through the year, Ben, municipal tax municipal sales tax revenue. Um, how's that looking versus last year?
That's a great question. Well, we're trending in about the same levels that we were last year. There are some communities that are outliers in Colorado that are in the 5 to 6% increase over their sales tax revenues last year, but the average that we're hearing out there is right around 2%. Some of the resort communities have fared a little better than other areas of the state, but the growth isn't what we saw in pre-pandemic levels by any means. And I guess, on the county side, given that we have a reassessment, year coming that at least here in Denver, for the first time in the last two assessment cycles, I didn't get a massive shock when I opened up my property tax bill. But there's been some recent legislation that's been thrown around and been defeated and then resurfaced about extending property tax payments. And I know that there's been some contention, from both sides on that. But really, the municipalities are faring well. It's when we start to see the budgets decreasing, and it's when we start to see the sales tax revenues going down to the previous year. That's when things really start to get a little turbulent here in Colorado. But from what we're gathering out there in the field and from what our board has shared with us is that most municipalities are just kind of chugging along, and that's not necessarily a bad thing. When you get outside of the Front Range, you're starting to see a lot of communities that historically didn't have an increase in sales tax revenue, namely the northern Front Range being up by Fort Collins and areas east of that. Then also when you get east of Denver, and then especially south of Denver is where we've seen a lot of growth. And then the more that you migrate off of that I-70 corridor from those resort communities and kind of the main access, highways to the Central Mountains and down into the Four Corners, we're starting to see that tourism pick up, and really municipalities have done very well. I think that there's going to be some trepidation from the county level as we head into the next assessment cycle, and what the growth that we mentioned earlier in this podcast slash webinar slash conversation, if you will, has really taught us out there. But in terms of where we're at kind of halfway through the year, most municipalities are faring pretty well. And so, some of the advice that I've been demonstrating out there and delivering to people based off of a lot of your forecast being State Street is to forecast for a little less interest earnings than what they saw. We still have 6 months left to capture the higher rates, but I think, as we discussed earlier on this call, is we do expect rates to go down. So I think if they can plan in the 3% range for an overall blend of their entire portfolio, they'll probably under promise and over deliver to commissioners and council and boards in that area. And we're certainly available to have conversations with anybody on the call or who watches a future recording. But I do think that we're faring okay, especially coming out of the last 5 years that have been pretty challenging globally. So we'll see what happens, but I'm still very optimistic.
Yeah, I think 3% is a very conservative estimate. I mean, we anticipate cash settling in around 3%. And one of the reasons that we forecast it there and not lower is because we think the Fed has gone back to what is more normal for a growing and healthy economy, which we think ours is, and that is in fighting inflation from above. If you think what they did from 2009 really to 2018, 19, is they were fighting inflation from below. In other words,
Mm.
they were trying to push because the global financial crisis was so severe and so damaging and so impactful for so many people. Prices were repressed for many, many years. And now we feel as though the market has gone back to a more normal inflation dynamic, which is really a central bank fighting inflation from above. So I think it's a very it's turning into a little bit more of a more normal relationship with inflation.
Yeah,
Um,
well, and that
yeah,
kind
go
of
ahead.
that brings me to another question, that came up as we were talking here is, where are you finding value in the yield curve right now? I mean, are you
Yeah,
seeing, T-bills, or what are you seeing out there?
yeah. It definitely depends on sort of what your benchmark is, what your duration allowances are. So I'll give you the short answer is we like treasuries. We like treasury yields. We like duration.
Hmm.
So whatever our benchmark is, we want to be long to that benchmark. We want to be extended in our duration. So if it's a money market fund like CSLIP, we want and the duration bogey is 1 day to 60 days. And 30 days is neutral. Then we want to be long. We want to be something 40, 45 days right now. Obviously, cash flows and things can move that around. But that's where we think about that from a liquidity standpoint. For our portfolios that have a 1 year duration, we're trying to be 1.25, 1.5 even, depending on the strategy. And we're using treasuries to do that. And we really like the 2-year notes and 3-year notes versus 5-year notes. So we know that many guidelines would allow as long a duration as 5-year, but we think there's better opportunities in 2 and 3 years from a roll down perspective. Now, that's an inverted curve right now, right? We know cash is yielding 4.25, 4.5, and we know that 2-year notes are yielding where are they? 3.85 today. And so you just have to sort of think about, the holding period if you want to take that inversion in the near term. But that's how we're thinking about it. From a credit perspective, we're cautious on credit. So we just don't see a great opportunity to swap out of a treasury and into a corporate bond, um, because we just feel as though things are priced so fully that it's not really worth that extra yield. We think there will be an opportunity. That week in the first week of April, the second week of April, there was a gyration. There was a credit spread widening. That we thought that was a pretty good time to rotate in on a tactical basis. So that's kind of how we're thinking about the curve. And then when we get points where the market rallies like it did in April, the rates market rallies like it did in April, and we think things are a little bit overdone, which is what we thought in that period of April, then we'll swap into some stuff that's floating rate. And we'll wait for those resets. We'll wait for an opportunity to move into something that we think poses a little more value. Now, what those on the call can do is they can buy a liquidity vehicle during that period, or they can leave their money at a bank and get paid a competitive rate there. So that's kind of how we're thinking about that from a opportunistic standpoint.
Great, great. No, and I think that's helpful. It's probably a good time to dovetail into the strategy your team is implementing for CSLIP. What are your thoughts for the next 6 months or time frame that you want to discuss for the fund? How's your team managing that?
Yeah. Very, very similar to what I described. We do see some structural opportunities. So we have an investment framework, structural, cyclical, and tactical. Structural are things where we can put relative value in the portfolio and that will just perform for us. So what's a good example of that? Buying asset-backed commercial paper. Asset-backed commercial paper, usually sponsored by a large financial institution, and yields more than what that financial institution's paper would yield in the market. So that's a structural trade. There's been a lot of asset-backed commercial paper issuance over the last 6 months. That supply has caused yields to cheapen up, and we've taken advantage of that and put that asset class into the portfolio. So we like that trade. I talked about the duration trade, but we're being very careful around that duration trade. We're not chasing rallies. If there's one thing that we know is going to exist, over the near term, that is volatility. There's a lot of noisy headlines. There's a lot of volatility in the marketplace. There's a lot of treasury issuance that has to happen. And so we're being very tactical in how we allocate into those opportunities. The month of May was a great example of a period of time where the April rally started to unwind. Yields started to push higher, and we saw that as an opportunity to buy those yields. So those would be the two things that we think are probably the best opportunities in the near term. And then, of course, on a macro standpoint, from a cyclical standpoint, the third leg of the stool, so to speak, we do think the next move out of the Fed will be lower. We think it should be 3 cuts this year. At the very least, the Fed's probably going to do two. It could be as late as October, December, but we are starting to see some weakness develop in the labor market, continuing claims being one of those weaknesses that we're seeing tick higher. And so we think will be appropriate. So therefore, we are trying to be long duration in light of that, anticipating that the next move will be lower.
Oh, that's great. That's great. I mean, that just gives a lot of the participants of CSLIP, an idea of not only the resources, but also the team and the strategy, behind protecting principal most importantly, and then trying to add yield without sacrificing liquidity. So that's appreciated.
Yeah, absolutely. So Ben, what about a C-slip update? What's top of mind for you?
Well, we've had just a year ago, we started taking deposits into the fund and contributions into the fund, and the board worked tirelessly to get the fund set up as another option for local governments. And I'm happy to report, in just over a year, you've seen it because your team manages, but we've had over 400 million come into the portfolio, and most importantly, recently, given getting our first year inception expenses between legal fees and everything else behind us. And I'm happy to report on behalf of the board that our expense ratio has dropped from 26 basis points down to 18. And that's added an extra 8 basis points of yield into the portfolio. Our yield is now very close to the other options available in Colorado, if not outperforming, depending on the day. We are now up to 21 participants. And what's really great to report is we've had two new board of trustees join the board, being Kim Archuleta, the Pueblo County Treasurer, and Steve Young, the Phillips County Treasurer, are both on the call today. So, I think a lot of people are seeing the approach that we're taking out there, which is these, keeping people informed, educational sessions, but then also having my team as a 20-year vet out there in the field, assisting local governments with their cash flow, looking at their investment programs, and really just trying to help guide them and really separate ourselves from a leadership standpoint by our team of all stars on the board, your team of all stars at the investment advisor, and then our approach to really being out there and being a part of these communities. So it's been phenomenal to see. And we do expect our yield to get more competitive in the coming months, and I think a lot of that has to do with our participants. The people that are on the call that are currently participating in CSLIP, or the ones that are thinking about it. We're all here to help, and we're all here to be a resource. And having the fourth largest asset manager in the world and one of the top cash managers in the world being your team definitely makes our job a little easier, with knowing that this fund is extremely well professionally managed, well governed at the board level, and well administered at our level. So I think it's been a phenomenal story, and this board put this together for the local governments out there to have another option, given the growth of our tax base, and to have another approach really focused on service and focused on education. So I think it's been a phenomenal journey so far, and I'm really excited to see where we go next. And I think that stay tuned, because who knows where we'll go at this point. And a big thank you to the board for being just absolutely selfless over the last year and volunteering their time for the betterment of taxpayers to give local governments another option. It's been amazing to watch that team work, and it's been amazing to work for that team because I am the board appointed administrator. So, I think with that, we planned on 45 minutes, but we're happy to open up the questions if you want to type it in the chat, or if you're brave enough to unmute and come onto the fishbowl here. Will and his team are available to address questions, and so am I, related to Colorado. So feel free to chime in or type a question if you have, and if not, we'll give it a minute here, and if not, we'll get you back to running your empires on behalf of your taxpayers a little early. But feel free, if you have questions. This is your time, or if you have thoughts or any feedback for us. This is your opportunity here. Okay. Not seeing anything come through on the chat. I guess, well, we must have inundated everybody properly if they don't have questions. But I can't remind the group enough to reach out to me, reach out to my team. We are here to assist you. We are here to help you, provide some information, provide some guidance. We appreciate. Oh, it looks like. Oh, all right. It's everybody saying thank you. So I guess that's our time to let them go. But thank you everyone for joining today. Will, thank you as always for taking the time. And for the board members on the phone, thank you for your time in putting together this different approach to managing public funds. We really appreciate everybody.
Thanks a lot, Ben. Appreciate it.
All right. Well, good to see you.
Take care.
All right. Bye bye.